We are going to be going into a strategy called mortgage rate arbitrage.
Let's do this!
This is designed to help you pay off, say, a 30-year mortgage in just 4 to 8 years.
Mortgage rate arbitrage turns the tables on the screwed up situation. Here are the steps you follow. So first you go out, you get a
Maybe later. I'll go put some beer in a bucket.
And I get it. It sounds like a scam, but it's basically using simple interest, which you can get through a HELOC or a infinite banking, a credit investor banking account to basically use that simple interest to pay down your amortized interest. Whether you're an accidental landlord, a savvy investor, or somewhere in between, this presentation will go through how to use this. I will note that this video is a bit old.
Eat a medicine, that's out of date.
I think I recorded way back when in 2018, and we had a lot of questions from investors back then. So I thought I would re-release it out, take out a lot of the fluff. But just know this strategy, it's great for paying off debt, which I think caters to a lot of people in the first floor or basement level of the wealth elevator. But if you are under $500,000, $1 million net worth, you have to invest in assets. And instead of taking the money from a HELOC or your infinite banking account, you have to put it into investments. So I'm going to be mentioning this a few times throughout the presentation because I think some people, they lose sight of really what the goal is. And again, instead of just paying off debt, it's investing in assets to grow your net worth that way. They call these things debt destructors in other parts of the world, utilizing either a HELOC or a credit investor banking account. If a credit investing banking, infinite banking is new to you, make sure you check out our free e-course at thewealthelevator.com/bank. But again, enjoy the webinar.
So as you guys know, my professional resume, engineering background, I am a project engineer currently.
I quit.
Real estate background, 2003, moved to Seattle, began investing with A-class rentals, and then started investing in probably the most wrong stuff that you probably shouldn't invest in, which are A-class rentals. And I became an accidental landlord that way. 2012, I went to out of state for cash flow. Into Birmingham was my first out of state market. And then I changed to my Seattle properties for Atlanta properties, Indianapolis properties, and this Newcastle, Pennsylvania property. Currently still W2 engineer, moved back to Hawaii recently, and I'm currently co-owner at MFP Investments. We have 620 units under control, and that's across 5 buildings in San Antonio, Houston, and Oklahoma City. So today's presentation is how to pay your 30-year mortgage in 4 to 8 years with mortgage rate arbitrage. Summary here, we're going to talk about paying your 30-year mortgage or 15-year mortgage in a lot shorter time by paying back with simple interest instead of amortized interest. And we're not talking about any of those tricks like paying off your mortgage with the extra payment a year or paying your mortgage with 2 bi-monthly payments, any of that nonsense. This is taking your mortgage, which is amortized, and paying it off with simple interest. And I know you guys are probably thinking, what the heck is this guy talking about? This is not real estate investing. And like I'm saying, I don't really want to talk about this topic because I don't think it's a very good strategy. I still think investing in real estate is the best thing to do. But unfortunately, some people don't like to do that and are unwilling to educate themselves and invest in something where they're the direct investor. And this is just the next best thing if you're unwilling to do that. And it's come up a lot because currently it's a seller's market and there's a lot of funding and there's lack of deals out there. People are looking to just throw money at deals these days that don't really make much sense. And a lot of people are just looking at a time to consolidate right now. Now is probably a good time to sell your worst performing assets. Quite frankly, that's why I'm actually looking to sell my entire portfolio at the moment. You can get good financing, but the deals aren't as great. One strategy is to get rid of your debt in this fashion, and especially in your primary residence. Is this something new? No, this is called mortgage equity arbitrage, also known as the Australian banking system. They do this. I just want to set the table first. What's good debt versus bad debt? So if you can see here, the bad debt is the 18 interest rate paid on something like a credit card. The good debt is taking out a 4% HELOC to pay down a little higher rate. A loan from your life insurance is another way of doing this. The HELOC is one good example. And then We talk a little bit about that internet banking concept where you get a life insurance, you take a loan from that policy. Another way you can harvest the monies. This is a good way of using debt where you're borrowing at 4% or a multifamily syndication at 20%, or a lot of you guys do the turnkey rentals on yourself, getting 30% and over, or even a higher risk syndication that's more of a development play. Like, who cares what the lemons cost? I think the important thing is just don't buy jet skis or other doodads with the money. And on a side topic, traditionally it's been good to go into debt for a college education, but there's always a crossover point. At what point does it make sense to do that? And that's why there's no hard and set definition for good debt and bad debt. It's whatever is the eyes of the beholder. For me, it's all what you can turn your money at. If you're just someone who doesn't really know, doesn't have very much financial savvy, and the best you can get is 5 to 8% in the stock market, then anything less than that's going to be good debt for you. But if you're someone who can turn money at 20%, then anything less than that is probably bad debt for you. So it's at the eyes of the beholder. And this is why this is a great area. And we'll get into that in a little bit. So the assumption that makes this all work is that because you're using a HELOC, you assume that the National Real Estate Association dogma that when you buy your home, it goes up in price. And that's what the basis of HELOC is, what the primary weapon that you're going to use when you're going to do this strategy. It's not guaranteed to go up. In America, it's been on the uptrend. But if you look at countries like Japan or some of the European nations, housing prices have actually gone down. Take Switzerland, for example. Unfortunately, mortgage debt is how most people can afford into home ownership because they don't have the necessary funds to purchase the homes outright. This is why there's that 30-year loan, so people can afford the monthly payment. And if you guys want, I have the simple interest and compound interest calculators and spreadsheet format. It's pretty cool. If you guys want it, shoot me an email and I can send it to you. And I'm currently working on a report that outlines why owning your primary residence is the biggest mistake you can probably make as an investor. The definition here, before you go longer, most lenders and banks are just salesmen for the big banks, and they get compensated when you originate a loan, just like a so-called financial planner gets compensated when you buy his crappy stock options. Always ask how are they getting compensated. Most of the systems out there, they're getting compensated when you purchase a fund. And it's just like insurance agents work like this too. A lot of the insurance brokers out there, they'll get a certain commission structure from selling you State Farm, whereas they won't selling you MetLife. I don't know how it is. It changes all the time, but that's what's going on in the background while they're pushing one policy more than another. So it carries on through all financial products, whether it's a loan or insurance or stocks. Often, maybe some of the options don't have a higher commission structure. It's just a flat structure. So the one rule I have is I don't take advice from anybody who has not become financially free and hasn't created wealth on their own. A lot of these guys, they're just salesmen and they just have sales jobs, and JOB stands for just over broke again. And what my problem is with these folks is they don't act ethically and in their best way for you. Yeah, they're not doing it because to be malicious. I think most times they just don't know. And their own system that they're in has fooled them into thinking that they're helping people get a new loan or do this insurance and that kind of thing. So it's just something to be aware of. Just the system is created in such a way that it's a self-supporting thing. So just take the big pharma, the health complex with all the expensive drugs out there. America's being prescribed up the butt with all this high blood pressure medicine, cholesterol medicine, and it's being sold as the first line of defense. And I'm not going to try to get political here. I'm just telling you to become educated and think for yourself, because this is how the system is created. And just so that you guys know, the average length of time for a home buyer to stay in their home is, and at that time they get a new loan, they sell their own old home, get a bigger one. And that all that means is cha-ching for the lenders. Even worse, if you go on refinance for a lower payment, which many of us have in the last few years in this low interest rate environment, all the broker has done is extended the amortization clock, pick up another commission for the loan, and you just got screwed again by the big bank. And because I will talk about this amortization thing in the front portion of the loan, that front portion is loaded with the interest upfront. So like your first payment, I think on my loan, it was like $2,000. Like a good portion of that, like 90% plus or minus a few percent points is going to interest. So these guys, they love that first portion because it's all going to interest rate and none of it is going to pay down that principal. So I don't personally invest in notes, but this is exactly what George Newberry is doing in his note fund. It's a good example. That's why he does his business, right? Because he's investing in notes. That's essentially what banks do. He invests in these notes. And when somebody actually pays it off or sells a property, you get a big payday because you get that whole money upfront today now. And I guess the bank kind of double dips here. And this is something that George doesn't do, but the banks will also tell you, hey, put your whole paycheck and savings in my bank and I'll give you back 0.1% a year. Again, that's another way that they get you in the end. We'll get into this schedule and a lot of you guys looking over the webinar can see the sample spreadsheet I have. If you guys want it, just shoot me an email at lane@simplepass.com and I can send it to you and you can play around with the numbers. But a traditional mortgage, like I said, is 30 years amortization schedule where you pay the same payment for 30 years and all the interest is loaded up front. Again, 90% of the payment is going to the interest in the beginning. To keep things simple, remember that amortized interest, which starts for A, is bad. And using a HELOC or the infinite banking as a conduit to this interest stands for, it's the simple way, simple passive cash flow way. And it's the better way of paying down the mortgage. In the spreadsheet, you can plug in different numbers and you can see how the interest payments and principal payments pay down as it goes along. I'm going to unmute it, you guys. And if you guys want to say a question.
About this lane, I go on. I just throwing this out just in case there's people wondering, what would be your response to the fact that for infinite banking, there's that interest rate risk versus from an amortized loan, you're locked in for your 30 years.
I don't really buy into that. As investors, you're always playing with the difference between cap rates and your interest rates, called the cap rate delta. So traditionally, your cap rates on apartment buildings are like 8%, and you're probably paying about 5 to 6%. So 8 minus 5%, that's 3%. That's how investors make money on that spread, the delta. So sometimes you'll have this thing called cap rate compression. And a lot of people get this wrong. They'll just complain, they'll say cap rate compression. But specifically what cap rate compression is when the interest rates came up a little bit. I think it was like 4% and came up to 4.25%. And then the inventory came in extra, or people just weren't looking to sell and the cap rates came down too. So as you can see, this cap rate, it compressed and it came together. And that in that situation, that's what makes all us investors very sad and grumpy in those times. This is the money slide. And I put a lot of logos in here because I'm assuming you guys are going to take screenshots. And if you guys haven't already, Shift Command 4 on your Apple computers or whatever you guys need to do, because this is where it's at. This whole 20-minute thing is boiled down to this one slide right here. So mortgage rate arbitrage turns the tables on the screwed up situation here, how it's done. And this is like the steps you follow. So you go out, you get a HELOC, which is a credit line against equity in your home or any other loan that is based on simple interest, not amortized interest. So this is a liquid line of credit that you can put money in and out without penalty. If you take a $50,000 loan against your house and you only want to use $5,000, then you're only going to get paid interest on that $5,000. And there's none of these fees going back and forth. Like I said, another option, if you don't have a primary residence or you're underwater or whatever your case is, to get a commercial loan or to use the infinite banking concept with life insurance to get another loan like that. If you don't, I'm sorry, I helped you there. People call these things debt destruction weapons. So these are all Googleable terms so you guys can look at on your own. So you go get this debt destruction weapon. We'll just keep using the examples of HELOC since that's going to be the vast majority of the cases. So you take the money out of your HELOC and now you're paying simple interest to pay off your mortgage, which is amortized interest. And step 3 here is you put your income from your paycheck, your day job into the HELOC. So this is different from putting it into your checking savings or under the mattress, making 0 to 1%. What this does is it pushes down your interest paid every day, since the HELOC is paid in simple interest and calculated with the average daily rate. So for you propeller hats out there, I've got this little calculation that you can follow along. If you're paying 5% on your HELOC, you're paying 5% divided by 365, which is amount of days are there in a year. And it's coming out to point. You just take that number and you multiply it by the amount of days you have that loan out. If you bought 100 grand, you're paying 0.000137 times 100 grand or $13.70. So you're paying about a lunch, cost of a lunch every day on that money. So this is what people freak out about, right? Like they're thinking, oh, debt is bad. I don't want to pay debt. I took out 100 grand. I still owe the 100 grand, but it's costing you. Everything has a cost, right? Like your health insurance. Everybody's freaked out about they need to have health insurance in retirement, or they want Social Security. They want to pay down into Social Security, which is this myth. It all comes down to a present day value and a cost. So in this case, the cost of having 100 grand today is costing you $13.70. And you're paying 5% in this case. And I would say this is quote unquote good debt, because you're going to go out and do something better than it. And while I'm at it, I wouldn't recommend you using it to pay down your mortgage. Is why I don't really like the strategy. I would like if you guys would go invest with the money, because now you're actually making money with it. But what you do with the money, whether you buy jet skis or use it to pay down your existing debt, is your own deal. Just don't buy jet skis. So you guys, number 4 here, just so that you don't go crazy making payments to your mortgage every day or week, you need to figure out what is the effective amount of chunking these payments to your mortgage from your HELOC. Because people can go crazy, right? They can be like paying down $20 every day, make an automatic payment every day, and it just gets absurd. You need to figure out how to do this. And it's not rocket science, but there needs to be a method to the madness, and it needs to be manageable. I think a good example is when you're chunking these payments, you want to have it in manageable size, whether it's like $1,000 increments, $5,000 increments, but have a system and have it be regular time intervals, whether it's every 2 weeks, every month, or every quarter. Have a plan. And what this requires you to do is have a budget, and you need to stick to a budget. And then number 5 here is pay off the HELOC and rinse, wash, repeat, and see how your mortgage got paid down in a fraction of the time it would have otherwise. And this works because you're making rapid progress to the principal balance and not just paying interest. Another example, in case you missed the bus earlier. So say you had a $600,000 home and you have a $400,000 first mortgage on it. You go out and you get a $100,000 HELOC, or debt destruction weapon, to start employing this strategy. You write a $50,000 check to the first mortgage from the HELOC, and you focus on paying off the HELOC in the next year or so. But I guess I'll use Dean as an example. Dean's wife is freaked out about this whole thing. She thinks it's crazy because she doesn't like debt. So this is why he only took $50,000 of the $100,000 available in his HELOC and to do this strategy. And he left $50,000 in case of emergency. So what he's doing is he's turning and burning his $50,000 as he makes it from his job and as they run a tight budget, and he repeats the process. And of course, it'd be a lot more effective if he went full into it and he did the whole $100,000 chunk. And this is where it gets like a little complicated, or not as simple, as you have to figure out what's your level of strategy to employ this. So by doing it at $50,000 at a time, it's probably going to take him about 8 times for him to rinse, wash, repeat this out and get debt free in a lot less time that it took him to do 30 years. Because again, he's sniping out the principal on the balance, not the interest. So I always tell you guys like what's the bad part of the investment. That's my thing. First, you need to have a positive cash flow in your personal finances. So if you're broke and you cannot keep a budget, this is not for you. You're going to get yourself into a lot of trouble doing this stuff, because you're going to take a huge HELOC and then you're going to go spend the money, and then now you're going to be totally screwed. Number two, you need a decent credit score to get a HELOC. Usually about 620 score or higher is what's needed. And third, you need to have equity in your home to get a HELOC to be able to do this. So if you're underwater or you barely have any equity in the home, you can't employ this strategy. And if you have anything less than 80%, you're not going to really be able to get at that money. Of course, there's 90% and 100% HELOCs out there. However, you're going to be paying a higher interest rate, but it's all a math game, right? Even if you're paying 6, 7% on 100% LTV HELOC, the math will probably work its way out at the end. And again, this is why I always say, do the math for yourself. The math will tell you. Don't listen to what anybody's saying, because your situation is always different than somebody else. And this is why I don't like the strategies. If you're incredibly efficient, sophisticated investor who grows their money at greater than 18% year after year, this is not for you. So if you're investing in syndications, you're doing the turnkey rental thing or doing the burst strategy or being a rock star at it, keep doing what you're doing. This stuff is for the people who will never educate themselves, never take action. So this is the best thing in that situation. And then again, some fine tuning is involved to get this optimized, but it's pretty simple. It's more of a personal finance question. Figure out how much as a household are you able to spend and save when your income comes in and goes out. The pictures are kind of meant to be funny, but it's not meant for people who don't have any money, no job, no income. I don't know how to create money out of nothing. If you're looking to be a wholesaler, no money down, creative financing, I can't help you. There's a lot of other sites. There's a lot more good information out there for you for that stuff. A lot of sophisticated investors hear this stuff and they shake their heads at the strategy as a pretty lame way to build wealth. And I agree. A mentor of mine told me a little while ago that a 30-year loan where you pay back the mortgage in future dollars and hedge inflation is the biggest hidden asset in there. And that you should hold onto debt as much as possible and try to get more and more of it. This strategy that we're talking about today totally flies in the face of that principle, which is why I always go back to the principles and why you're investing. This is why I had a double take, because I want to be grabbing onto as much long-term debt as I can and never paying that off as long as I can. If you guys listen to a podcast back with me and Sep a few podcasts ago, we discussed inflation coming to the United States and the global economy to pay for the 2008 bailouts, and the exit from the gold standard is the reason why inflation is coming and why you don't want to be doing a strategy like this. Mortgage rate arbitrage is a pretty good strategy, but it's not better or best. So it's the level one in a 3-tier tower. The issue with mortgage arbitrage is that you're merely growing your money with the pace of inflation. And the strategy requires you to always have a positive cash flow. Or in other words, you need to be running a tight fiscal budget where you don't spend your money on things you haven't planned for. And your primary residence does not produce income like rental income or rental properties or private placements. Like I said, and what I'll put in that report in the future, but your primary residence just merely keeps up with the pace of inflation. This is probably the last slide here. Do some homework on Googling on HELOCs out there. I know here in Hawaii, everybody's got some kind of promo on HELOCs. They will have anywhere from 0 to 3% intro promo rates. I think 2% for 3 years is the average. You could probably play the game where you go to Bank of Hawaii, then you go to First American, then you go to Cousins Bank or whatever, and you switch around every year or two. But if you're doing that stuff, your time is better spent doing other things like finding better investments, because that's not your highest and best use. Or you should spend more time at your job and work more hours instead of screwing around doing stuff like that. And if you need someone to go walk through the mortgage rate arbitrage and fine tune it, yeah, give me a call and it takes it out, probably just knock it out in an hour, a la carte coaching. You can click the link there. I don't really want to do this strategy, but if you guys really want to, it's here for you. The action plan, if you guys are looking for more, we prefer not to be screwed by the banking system. Subscribe to the podcast and the YouTube channel and interact in the Facebook group. Right now, I'm keeping the Facebook closed. So only people who get in are people who I have talked to on the phone and have vetted. There's a lot of people I actually turn away from the group because I think they're a lot of takers out there and a lot of people who just don't really add any value. So don't let them in. And go to the website, get added to the Hui Deal Pipeline Club just to see some deal flow coming your way. Because as much as I don't like the strategy, for a lot of people like myself, like a few years ago, there really wasn't any alternative. So it's the best alternative to nothing. So start seeing some deal flow and then you can start seeing, oh, okay, I can see 15, 20, 25% is attainable with these deals. And then you can start venturing out into bigger, better things as opposed to just playing this game with your mortgage. And if you want holistic advice, again, I do the coaching, but I don't really want to do the coaching because it's not really scalable. But for some people who like to do it, it's there. And then sign up for the Hui Deal Pipeline Club for access to the simple and amortized spreadsheets that I have for you guys so you guys can play with this stuff. Any questions out there about the strategy?
So this is Jeff. So when I looked at this, it didn't look like it actually works or barely works at all unless you have either a pile of money sitting around or like a fairly large net positive cash flow every month where you're basically paying like big chunks of additional principal on the balance. Is that your understanding? Or like when I run the math, you were talking about pennies almost. Not pennies, but you're talking about like hundreds of dollars a year kind of thing and not tens of thousands of dollars unless you had a lot of money extra every month.
You're right. When you do run the numbers, it helps, but it's like it's a fraction of what you could be doing if you're actively investing your money.
Yeah, it made the most sense to me in the meantime, because sometimes I have money sitting and I don't have a deal and I'm waiting for that next deal to come. It'd be nice to park it and actually be making 4% and not 0% on it or 0.1% or whatever for those 3 or 4 months and then just take it. But yeah, it doesn't seem like it works that well unless you actually have a fairly positive cash flow in your personal finances every single month.
But if you didn't know anything about anything, this would be the next best thing. That's what I'm trying to point out today. So what I do is I'm waiting for these syndications that come out that offer the best security and high returns. It's nothing like 30% a year, but it's pretty dang good returns for the amount of risk as I'm in. But unfortunately, I have to sit around and I have these syndications. You can't just put $1,000, $2,000, $5,000, $10,000. You got to put a big chunk of change. So that means like you're sitting around with this big chunk of change, not doing anything in the bank. So that's been my challenge of late is to find decent investments that have liquidity there in the low teens that I can get. It seems from the group that, yeah, hey, Connie.
I have used this strategy before. I know this presents a turnkey investment, but knowing this strategy, it helps. For example, if I had $200,000 before and I want to buy as much as I could, and knowing the limit of the loan is 10, I use that 200,000 down payment and spread it out and get the loan amount that I can get. But now that it's all settled, I realize that some of the loan, like only $50,000 or $40,000, I want to do this strategy to kill one or two of them, open up more room for me to buy in the future. Then I'll use this strategy just to choose the smallest loan or I can free up that number of loans. The best, safer way to do it, not to use the full HELOC amount of 50,000 to pay off one loan at once. That's too risky. I would do 10,000. So let's say a month you have $2,000 cash flow and you don't use it. If you take 10,000 on that equity line and pay off that loan, every month you route all of your cash to that equity line for paying down. So let's say your paycheck paying on a 15 or every 2 weeks or every week, it hits that HELOC account and it stops the interest calculation. So by routing all of those cash flow amounts to that HELOC, it pays out even faster. And you limited the time. Let's say 10,000, I can pay it up in 5 months instead of it's the whole 50,000 and track the time out and you don't know when it's going to end because you don't know what happened in after 6 months or a year. So I would do increment like that. Take 10,000, pay it off, route all the cash flow and pay off that HELOC. As soon as the payoff, you can repeat it again with payoff. It's faster that way and it's safer. So I did that before and it worked. I got successful paying off my primary residence using that. But
So
then after paying it off, I create a huge HELOC out there and just waiting for the next best thing. Again, because of how I buy all the property, I spread my money out. And now that I have a small loan, let's say 4.5% interest rate, I think I can just pay it off and then open up another loan for me to buy in the future or get another property in my portfolio or something. So that would help. So
So
it's
of
not,
course, this is like a very how much you implement the strategy is really personal. What
yeah.
if you had 100,000, you're able to get $100,000 HELOC, or no, let's call it $200,000 HELOC. Let's say you had a huge HELOC. Would you take
Mhm.
it down in 10, like $20,000 at a time, like 10% of the whole HELOC? Or is it more
No, it's
based on your cash? You have to take into your cash flow, your personal finances too.
you have to know your monthly expense, your monthly income, and what your net cash flow is, and where is it coming from. Because if it's coming from your rental, then it's unpredictable. It's not the same amount every month, right? But if it's your paycheck, you know exactly that it's coming. Then you will have the employer direct deposit your check directly to that HELOC. Because if you have a direct deposit to your checking account, then you transfer that to your HELOC. It takes another couple of days. So if you want to set it automatic, have the employer check the W-2 check direct deposit to that. Secondly, sometimes I even use that HELOC to pay the credit card, and then every month on my W-2 income or the rental, I have a direct deposit back to the HELOC. So it automatically fill it up by itself and it clear the debt a lot faster. But to answer your question, it depends on what your strategy, what you want to do. Like I said with my example, it changed, right? My strategy changed. At first, I tried to use all those cash to buy as much as I could, and now I stuck with only 10 loans or 20 loans, a little bit less than. Then we have to release some of those loans, and we have to use this strategy to pay off some of the small one or whatever we're comfortable with on a good property so we can have those cash flow every month. So it depends on each person's strategy, but that could help to release some number of debt for people too.
So,
Right.
Connie, it's like you're using the HELOCs as like your working capital, and you're having all your just cash working for you.
That's correct.
Yeah, I mean, for me, I would rather not use a HELOC, and I would just rather spend more time finding deals and placing that into like private money lending or something like that. It's just no one's wrong here. It's just different preferences.
Yeah,
Right,
I
right, right.
understand, but with the new one coming in, just they only know what they know and have the limit capital that they have. They have to shuffle things around. If they understand the strategy, it helps them a lot. If they don't, like I said, that's what I did. I only have a limit amount of money and time that I can be able to buy those property. Then I did what I supposed to do at that time, but then now that everything's settled, cash flow coming in, I can't buy any better deal right now. Then I was thinking, okay, so which low I can knock off so to lower my debt to income ratio so I can be ready for the next one. Just to know the strategy and move things around help.
Yeah. I think I think you're totally right. And I think that the person listening who's very new to this kind of stuff it's really complicated, and it's just another reason for them to ostrich their head in the sand. It's fine to have all your money, find prudent investments and invest the damn thing. Right? It gets complicated when you're trying to do these better or decent strategies in between. I know you don't want to go into bad investments, but I don't know, it's very interesting. I know a lot of you guys, when I talk to you guys, like about 30 of you guys are getting HELOCs and using the HELOCs for down payments, which at first I was really against. It's using your home equity. And I was really against that because again, I believe that at any time the HELOCs can go away. All the arrangements with the banks are a little different. And just for that reason, I didn't want to be in that position. I do see some of you guys doing it. Like you guys aren't investing the whole thing. If you have $100,000 HELOC and you want to take just 30 grand and buy a turnkey rental, and you're going to be getting that much more cash flow to make up for the interest rate on the whole entire thing in case you have to pay it back, then I think that's pretty prudent. Any other thoughts for folks that have tried it?
Hi, guys. This is Sylvia. Just wanted to add my 2 cents in. So, I've been practicing this strategy for many years, both personally on paying off debt and then going into investing in some turnkey rentals. So, I agree with Connie's methods and how she's applied it. And we have done similar. One of the great byproducts that I wanted to just remind everyone as a result of doing this is when you are applying every extra dollar into the HELOC, every time you transfer into it, the bank sees you as making a payment. Over the long haul, or even over just a matter of months, your credit score really goes up significantly. I don't know if anyone else has experienced this, but the beauty of also using a line of credit is that it's revolving. So you can actually float debt too. And I think it's smart for those who are using it to leave room in there. You never really want to maximize or get even very close to the maximum. So it's been working good. And one of the things that I've learned from just playing with the strategy in different ways is that to maximize leverage, I would rather if I had $100,000 in a HELOC or maybe at 150,000 is to tap into the 100,000 and spread it over, for example, just put 20% down on 5 properties that are 100,000 a pop. So that way you can basically strengthen numbers. So even though your cash flow or your net income is smaller for each property, just in volume, you're getting 5 times more of the cash flow. So all of that is adding to paying down the $100,000 that you're using. So it's been good, but it's really what your goals are.
So like you implement Australian banking system. So you use interesting terminology, like the way that the textbook way is to keep your water level at like 0. So if you buy a refrigerator for $1,000, you dip below $1,000 and eventually you'll replenish it. But I think a more prudent way is to make that water line maybe $10,000 above your annual budget. Are you using any kind of, so you paying bills in and out of the banking, out of the HELOC? Are you taking the
Yes,
stray that far?
I have. Yeah.
Thoughts on where do you put the water lines so you're not freaking out about this stuff all the time, or you just have so much trust and confidence already by doing it so long that
We try to keep at least 25,000 of free credit line in there, not using 25,000. To phrase it a little differently, it's not a HELOC that we're using. We're using just a regular personal line. It's not a huge, large credit line. Yeah. It's good for even beginners if they want to tap into implementing the strategy and say they don't have good credit. They can even start with a $2,000 secured line of credit. And within time, just a few months of floating the debt and they take out 1,000 today, they put in 1,000 tomorrow, the bank sees that as making a payment. So in very little time, their credit is going to shoot through the roof and they'll be in better position to get like a personal line of credit. So it's really good for just taking the steps and building wealth and then eventually getting into the investing to increase cash flow.
so you're giving them cigarettes when there's harder drugs in the future.
Yeah.
So
And of course, with the caveat that you are educating them into how to use it the right way.
some people just dive right into the hard stuff right off the bat.
So, of course, this can be dangerous for all of the reasons that you disclosed for the people that don't have the income and positive cash flow.
And just to take a counter argument, I think this stuff is confusing. When somebody comes to me when they have a simple situation and, hey, we make $30,000 after our W-2 income and expenses, and this is what we want to do. There's our liquidity. I'm like, cool, let's go you do a single family home. It's simple. But like when
Right.
people have a lot, like huge amounts of liquidity because they've just been doing like the stock market their whole life or make less, go talk to someone who like can figure this stuff out for you. Take a look at the gold, bronze, and like silver, like healthcare stuff. It's so confusing. Those of us fortunate enough with W-2 jobs, all that stuff gets taken care of. It's simple, right? Just like simple passive cash flow. You just get the investments. All this stuff on the lower level, I think is really confusing and it just makes it harder for people to get started. It's just another excuse out there. But that's my 2 cents. That's the end, guys. I was to redirect billions of dollars from Wall Street casinos and corrupt financial institutions and the financial salespeople we meet along the way, and to help the endangered middle class like us find more profitable investments, investing in Main Street opportunities that actually benefit real people, just regular people housing.